the hardest time to borrow money is when you need it, right? So I like the idea of having cash available for whenever I need it.
All right. Hey, Rent Retirement family. It is Cori. I have taken over the podcast from Adam. He is not going to be here today, but I've got Zach, I've got Harrison, I've got another Adam. So we kind of have an Adam here. And we're going to kick this off, have some fun, and talk about all-in-one loans. So yeah, gentlemen, let's kick this off.
Yeah, we're excited, especially with the client pool that you deal with. I think this loan is perfectly catered to help people accelerate not only their investment portfolio, but just their financial freedom in general.
I love that. And I mean, here's the thing, guys. I mean, let me just say this first. We've all heard of different loans. We've got our conventional loans. We've got DSCR. We've got interest only. We've got, Aunt Sally, that lives in Cleveland giving us money. There's all these different loans. I mean, I don't know how many of you have heard about all-in-one loans, and that's really what we're getting into today. So that's Adam and Harrison. We're super stoked to have you because, I mean, what the heck, what is an all-in-one loan? How does this work? Like, what do we do?
And can we start with just a quick intro of you guys, what bank do you work with and who are you, your background? And then definitely let's understand this all-in-one product.
Yeah, certainly. So my name is Harrison George. Obviously, that's Adam Pugmire. We work together and we're at a mortgage company called CMG Home Loans. It's the largest privately held mortgage company in the United States. I know that the numbers have changed, at least in the last 12 months, but we do about $750 million to about $1 billion in residential financing every month. We're not only a retail mortgage company, we have wholesale correspondent. And someone wise once told me we have a fourth division called servicing. But ultimately, we do residential financing, but even more than that, we kind of like to just look and solve problems. Even if we're not the one that's involved with it, we really are more of a solutionist more than anything else.
Yeah, I've been in the industry for about 12 years. Harrison came in and mentored under me 4 or 5 years ago, and he's surpassed the master. So he's out producing me, and we have just kind of created an awesome little team here. And we love solving problems and being creative with finding lending solutions.
I love it. So tell us about this all-in-one loan. Is this something that is new? It seems like this is something that has recently surfaced, maybe because we have this interest rate volatility right now. Is this something that's recent? And like, what exactly is this?
Yeah, it's not necessarily new. So the concept's been around for a long time. In fact, the concept was really introduced. The owner of our company, who's very politically involved as well, went to an international lending conference in the early 2000s to Australia. And in Australia, they call this concept an offset mortgage because the idea is that your checking and your savings actually offset your interest costs. And so it's a pretty common concept there. He came back to the United States after going to this conference and was like blown away by this concept, tried to find an option to be able to broker this loan and couldn't find it. So he pioneered it in 2005. And we've had this loan since 2005. We've rebranded under a different name. I think it was originally called the Home Ownership Accelerator in 2005. Yeah. And then after the financial crash and some changes in the industry, we did some rebranding and kind of strengthened our base. We added additional lines of credit for ourselves so that we didn't have to worry about volatility. And prime example of that, when COVID hit, a lot of lenders were tightening down on home equity lines of credit and did different things like that. And we virtually went uninterrupted during COVID as it relates to home equity lines of credit. And, we could do them home equity lines of credit on investment properties, which not a lot of people do as well.
And I want to talk about that because that's an interesting thing. It is very challenging to find someone who'll do HELOC on an investment property. I'm curious to see what kind of the LTV and things like that would be, but not to distract. Can you, just for someone that's never heard of this, can you just walk through fundamentally an all-in-one loan? Like what is that? I mean, I've heard certain things as far as kind of similar to a HELOC, but to walk us through the mechanics of it, maybe with an example if you can.
Yeah, so I'll give you kind of just a really simple Reader's Digest type version of it, right? You've got 50 grand sitting in checking and savings that's earning little to nothing. Sometimes the banks are paying a little bit more than normal right now. But historically speaking, you get nothing. You got some peace of mind with that 50 grand sitting in a checking account, but it's not doing jack squat for you. You buy this little $150,000, I'm going to use random numbers. We'll use a $150,000 purchase price. We have a $112,000 loan or whatever, and that 50 grand sitting in a checking account, and you're paying a 30-year amortized loan, or maybe you do have an interest-only loan on this this $112,000 balance on the investment property you just purchased. But with the all-in-one, that 50 grand that you have setting that's peace of mind can actually be deposited against the balance, and you only pay interest on the difference, but you still have full access to the cash. So unlike a traditional mortgage, if you were to accelerate your pay down with the 50 grand and put it into the mortgage, you could say goodbye to that money. You're not going to get it unless you refinance or sell the property. But with the all-in-one, you have the full flexibility to move the money in and out, and it allows you maximum efficiency of the use of your dollars. So really, that's kind of a simple way to put it. For me, I'm a W-2 guy. That's what I do. So my W-2 check hits my all-in-one account and my checking account, and there's a built-in sweep feature. So at midnight, or 11:59, or what the exact minute, I'm not sure.
You got to be specific with that.
It's 11:59. I always say midnight, but at midnight, the checking account sweeps to zero. It shuffles over to the mortgage and drops the mortgage balance. And because interest is calculated daily, it really compounds and accelerates the pay down, giving you even more access to your cash. So
that's like that is like a HELOC where the interest you're paying is associated based on the daily balance, right? And as you're earning, and you're basically using this as a banking account as well that you can pull from.
Correct. Yeah. For me, there is a checkbook tied to it, a debit card. I try not to use those.
I shredded mine because early on, Adam we bought burgers. He spent $4 or some on his debit card. And he was like, my mortgage balance just went up. So he takes advantage of credit cards and points and all the other stuff.
I max out the credit, I max out or put all my payments on credit cards, pay them off at the end of the month. I think most of the people that are watching this are probably already doing similar things like that already. So that's the other thing that's nice about this. It really, other than the fact that the stream of income is going to an account that you're not accustomed to, you have a banking interface change. There's really no disruption to your day-to-day. Very few exceptions. I mean, almost any. I would say 99 out of 100. There's no disruption to how they already do business. Now,
and that's a big thing because the making this automated. Like if this gets too complicated, right? No one's going to do it.
Right.
Let me just. And I cut you off, Adam. What were you going to say?
Good. No, you're good. Go ahead.
Let me read this back to you just as an example to make sure I fully understand this. And I'm going to use a little bit slightly different numbers. But let's say you buy a $200,000 house.
Okay.
Cori's your investment strategist and got you a sweet deal on it. So you know it's going to be successful. But you have, instead of having and you put down $50,000 as your down payment, and you have, let's say, another $50,000 in just sitting in your bank account.
Yeah.
So instead of having a $150 or $150,000 loan, because you've already put $50K down, you pay that, and you have that $50,000 from your checking go in to cover that loan. So now your loan balance is $100,000, which you have your normal loan payment associated with, and then you have interest only based on the difference, that $50,000 that you shuffled from your bank account. Did I overly confuse this? I mean,
no, you didn't. Actually, you simplified it, and
it's very simple. Correct.
I'll tell you the part, and that part's really easy to quantify. You got 50 grand, you put it down. Now you only pay interest on 100 grand. The part that is really powerful that most people miss is the money they spend, because the money you're spending on groceries, house payments, insurance, fuel to fill the car, all that money, while it's waiting to be spent, it too is sitting in the account offsetting interest. So for simple math, if you're spending $10,000 a month just on life, and half of that money sits in the account for half the month before you actually pay that out, you don't pay interest on $5,000 worth of principal, and that money actually was spent. So the money that you spend actually compounds over time as well in the form of savings, in the form of interest offset. And the beauty of it is, because it's interest gain or interest saved gains, it's not actually earnings, it's non-taxable cash in your pocket as well. Because if you save 20 grand in interest over the course of the year, you have $20,000 extra in your pocket, but that $20,000 isn't taxed.
This is somewhat comparable to, we've heard of different strategies in the past where people have paid off their mortgage, right? They're actually paying down the principal quicker. So they pay it off in 5 years and they just use it as a checking account. Mm-hmm. So I kind of compare to that a little bit, but let me just back up and be abundantly clear. In my example, $200,000 house, you put $50K down, you pull another $50K from your bank into this. I guess it's this account, right? It's sitting in, or you're paying your normal mortgage on the $100,000 that's still there that you weren't able to pay down. And the $50,000 that's in the account, are you paying interest on that or no?
No.
Okay,
No.
so you're just putting it there as a placeholder.
It's essentially, one way to look at it would be it's offsetting interest at the exact same amount, right? So for simple math, let's say it's 10 grand, right? And 7%, that's $700 savings. That $10,000, the $700 that you would normally pay in interest, that every 10,000 is saving you $700 in interest annually, right? So that's essentially how it works. You're basically, we have to be careful of saying that you're not earning it, right? You're not earning money on it, but it's actually offsetting interest for the equivalent. So it's dollar for dollar savings.
Definitely more relevant in times like this where we have higher interest. I mean, this is probably or higher interest rates. This is probably why this has come up more often than not. And I always tell people too, is because the question is, do you put more? We get the question about, do you put more money down to purchase a property, or do you make more principal payments? And usually my answer is always no to them, because of your earlier point about your mortgage is kind of a one-way street, right? When you're paying it off, you don't get to pull it back out until you go through like a refinance.
You do
something
now.
like this. So yeah, this is a good option. Cori, I know you've had some people that have done this recently, right?
I have actually talked to one of your clients yesterday, and she's super stoked. So she did it on her primary so that she would have money for more investing. I guess my question there, and just having happy people, do you kind of recommend this, like, because obviously rent retirement, it's going to be all investments. Do you recommend this for like an investment? Do you recommend somebody sets this up on personal? Can they do both? Like, what do you kind of?
It depends.
Yeah.
Okay.
Ultimately, it kind of depends on what the math or the numbers of the actual person's scenario looks like. It's at this current moment, it's kind of difficult to justify for most people. Oh, I have a 2.25 on my primary residence. It's like, hey, let's not touch that. But you're planning on buying an investment or buying a second home, and you already have that intention to do so. Comparing it to where rates are for those types of properties versus the all-in-one, we just have a calculation that we run, and it's not like we're running any kind of magic on it. It's just, let's look at your scenario. Let's make sure we get accurate numbers. And it's just math. Let's just see if the math pans out.
Well, and the math pans out so much better on this loan in general because the math is calculated different. Most people perceive the 30-year fixed interest rate loan as risk-free, but it's not risk-free. It's just, the risk is just predetermined and front-loaded interest. It's predictable, but it's not risk-free. I mean, let's not be twisted about it. You pay a grip in interest over time, especially where the rates are right now. I had an example just coincidentally of someone who purchased a home through rent to retirement in November. And they were referred to me last week, and I met with them yesterday. And so he had his first payment in January on a 30-year fixed loan, but he didn't know of this loan previously. And I met with him, ran through the scenario, and he literally said, he goes, well, I guess what's the next step? Because this is obviously a no-brainer. So he's going to be able to pay off his house in 1.8 years is one scenario we ran, and the other one was 2.9. So it was kind of like there was no, even if it went sideways, it was still completely smoked the doors off of what he currently had offered on his existing mortgage.
So to be clear, this is a scenario where you are talking about paying down the loan as you earn income, right? As you consistently. I mean, what about someone that could buy a house cash though? I mean, is this a scenario where they could?
I think it's ideal.
Me personally, I would look at doing it. I would look into doing it the loan. I would put the minimum down payment required for the loan. Once the loan was opened, I would pay to the loan down significantly, and then I have access to the cash. The hardest time to borrow money is when you need it, right? So I like the idea of having cash available for whenever I need it. I've bought homes cash with my all-in-one because I had it available to me. So I'd rather have it available to me now rather than need it and then have to try and race through it and not be able to do it.
So let's talk about some logistics with this and very close details on like
Sure.
what does this loan cost? I was under the assumption you're buying with this loan, but it sounds like you buy with the normal loan and then you underwrite with this. Can you clarify?
So you can purchase or refinance with this product. You could buy with it, or if right now is not the time to buy with it because of certain requirements, credit score, DTI reserves, et cetera, you may end up potentially refinancing into this option.
Okay.
Yep.
And a refinance is the underwriting criteria the same as far as
Yep.
like DTI and
Yep.
LTV?
Exactly. Yeah. So some of the kind of the main points associated with this, For primary residences, you're talking about credit scores at 700 and above, but for investment properties, you're talking 720 and above. For credit score, obviously, need debt to income ratios below 43%, preferably below 40. And if you're in between 40 and 43, you would need a total of the total line of credit. You would need 15% of that in reserves. So it's just kind of like a little bit of a tiered system, which is, kind of proof that this person can save funds.
And those reserves can come in the form of personal checking, savings, 401k, IRAs, all kinds of different ways that we can calculate those reserves. But there's also some additional enhancements that are sometimes helpful. I don't know that it would necessarily be applicable for most folks, but if you have far and above, let's just say you've got $1 million in a 401k, we can actually take the 401k, 70% of that asset, divide it by 120 and count that as monthly income. So from a qualifying standpoint, we can get creative sometimes when needed to help people qualify if their spread's a little bit thin or whatever the situation might be.
I love that. Harrison, we've been working together for a year now. I don't know that strategy, but I like it. It's kind of sexy real estate right there.
Yeah, it helps those people that like to write off a lot of their income because they're self-employed and they're being creative with their financing.
No, that's awesome. And gentlemen, how many of these can you have? I know some loans have limits of how many you can have. And just for our listeners, and I mean, we've talked about this, how many all-in-one loans can you actually do? Is it like just one? What's the limit?
Great question. Technically, I guess 4, technically. It would require an exception to get a 4th, but so we have 2 different investors and you could do a primary investment with each of them. And I suppose you could, there's not a lot of practical applications for that many at one given time because most people don't have that many streams of income. So if you don't have a stream of income to flow through this, essentially all you have is an interest only loan, right? So if you have maybe your W-2 income and then you have your real estate portfolio, your real estate portfolio's funneling everything through one property and your W-2's funneling through your primary property, that would be a justification to have 2. A third one, if the interest only portion of it made sense to have a third one and you didn't have a third stream of income, that might be a reason to do it because the interest only portion of it makes it cash flow better. But typically speaking, if there's not a third stream of income, a third one doesn't make sense in most situations. And Harrison and I's approach on this, by the way, I mean, last year's kind of an exception. We did probably north of 50% of our business was this product, but we still do the forward mortgages, investments, and primary residences and all that stuff. But Harrison and I are really similar in minded in the sense that when we talk to a client, it's like if my brother comes to me and says, "Hey, Adam, here's my situation. What would you do?" I try to treat literally every single client the same way I would give that advice to my brother because there's not any one commission or any one transaction that I'm interested in making a commission on at the sake of having bad press or someone frustrated about what they're doing. And Harrison would be the first to admit that he's heard me and I've heard him say, "Hey, we're probably not the best fit in this situation, but let me see what I can do to help you find a solution for you so you're not chasing your tail." That's kind of our approach. We're not trying to hard sell anybody on the product. If it doesn't make sense, we're not going to pitch it.
This is assuming that you like your brother, right, Adam?
Yeah, I do. That's a good point, though.
Yeah.
So this is just one product of many, right? This is just one thing in the lending world to explore, to educate yourself on, and see if this is the right fit for you. And there could be some advantages, and not something where you would have 10 investment properties under this loan because I mean you're really just using this as a like bank account to some degree, and so it's saving the interest for that, and so it's something you would do creative unless you have a lot of streams of income and a lot of capital that you could spread across multiple properties, right? Yeah. But just to be clear, so are you capped at like a 75 or 80% LTV? I mean that on your refinance or if you're buying with this property, that underwriting criteria is the same, right?
Correct. Yeah, you're on a cash out, it'd be 70%. On a purchase, it'd be 75%, so 25% down on a purchase.
Okay. No option for 80% on single family? Not
on an investment. There is for second home and for primary residence.
And you can actually go up to 10% down on those.
That's true. Yeah, on a primary residence, we can do 10% down.
Okay. Yep. If they're doing primary 10%, got it. What about, let's talk a little bit more about what situations don't make sense for this. Harrison, you talked a little bit about like if they have a super low interest rate. I mean, when would someone not want to consider doing this? Because the way I look at it, just without getting complicated. Just if you're saving interest, right? And to your point, especially in high inflationary environments, you keep your money in the bank. Yes, it needs to be accessible and you need to use it for life, but it's also, you're also losing purchasing power of that property or with the capital just due to inflation. And then you couple that with high interest rates, you're kind of getting a double whammy there with high interest rates on some of these loans that you're taking out right now. So that's a way to kind of combat that a little bit. But what situations does this not make sense in?
So kind of like what Adam was mentioning just a few minutes ago about, you earn your money and then you're going to spend it on a bunch of groceries and whatnot. If that money that you earn every month and what you spend every month is pretty close to one another in the sense that you're not retaining much money on a monthly basis, then it's possible that this may not have the benefits that you would be hoping for this product. And to kind of go off on a little bit of a side tangent, a 2.875, 3% 30-year mortgage, people go, I have a low interest rate, but we're kind of not just talking about interest rate, we're talking about interest cost. Just because the all-in-one may have a slightly higher interest rate than your 30-year mortgage does not necessarily mean you're going to spend more in interest. And we determine that again by how much is retained on a monthly basis. But even more than how much is retained, it's when you spend your money. If you earn your money on the first of the month, let's just say the person in your scenario, $150,000 mortgage, they made $100,000 on the first and they spent $99,000 on the second. Well, they only took advantage of one day of their balance being down to $50,000. But if that person kind of had the same scenario where you earn $100,000 on the first and pay all of his bills off on the 29th of the month, well, you'd take advantage of having that reduced balance for 28 or 29 days of the month. So not only when you earn your money and how much you spend, but when you spend your money is kind of like three major important factors associated with this product.
Yeah, I think most people, at least within our demographic of investors, they're not living month to month. They have additional capital that they just are keeping in savings. And so this could be an option just to get a use out of that. So you mentioned a few differences, and I really want to hone in on this point, like specifically comparing and contrasting. We see the benefit of it, right, and how it can be strategically used. But just for awareness, a slightly higher interest rate than your regular conventional. What about additional fees for this loan, or are there transaction fees as money is coming and going?
Great question. As far as the rates or the fees go for the actual origination of the loan, it's going to be very similar to any traditional loan product. So unlike a normal HELOC, which sometimes doesn't have fees associated with it, this is going to be treated like a normal transaction. You're going to have your underwriting, processing, title fees, all third-party fees applicable. So nothing higher or significantly lower than just a traditional transaction in that regard. As it relates to money flowing in and out, there is no early payoff penalty. If you use an ATM, we don't have a giant footprint banking wise. If you use an ATM, we will refund up to 10 ATM withdrawals a month, if whatever third party ATM you use. And there's no other fees associated with. There is a $60 annual fee charged in year 2 going forward. Other than that, that's it. There's no hidden fees or items.
Are you guys licensed in all states? Can you do this in all states, or most?
CMG has presence in all 50 states. There are limitations in certain states like New York, New Jersey. Some states have some LTV restriction requirements, but yes, the product's available in all 50. And
Adam and I are licensed in probably 48 of those 50 combined. And he's got a few there, I got a few here, but for almost
we pretty much overlap the whole country between the two of us.
Yeah.
No, this is cool stuff. I like this. I think that could be applicable to a lot of people, especially in that scenario where, they have high balances on their mortgages and high interest rates and money sitting in savings doing nothing, whether that's primary residence or whatever. So someone that's not doing a primary residence, just to clarify, they do a FHA or VA, they actually need to come to the table with capital, likely, because they're going to need to have 10% down total on their primary. Or
depends on when they bought, right? If they have equity.
Yeah, if they have equity right now and they've owned for a few years, fantastic. They wouldn't need to. But
to go back real quick, Zach, to your original comment. So there will be some practical applications where it actually makes sense for someone to refinance their primary and use capital from there for down payment on investment properties. But when you're comparing apples to apples in terms of investment 30-year fix to the all-in-one, I would say for the vast majority of your clients, the all-in-one's going to smoke what they're looking at. I would say for the majority. I would be shocked if it's not close to 80% of the clients that are actually your typical cookie cutter client that you normally deal with. I would bet 80% of them that the all-in-one would actually be a better fit financially. I'll give you the prime example that I met with yesterday, the guy I was telling you about. When I ran his effective interest rate, again, his rate we ran for him was 7.5, I believe, on the all-in-one. And I think he had 7.25 was his 30-year fix that he already had. He's only had it for a couple months. When I ran the all-in-one with his extra cash flow, his lump sums in savings, his effective interest rate was 0.56. He would have to have had a 30-year loan at 0.56 interest for it to equate to the amount of interest that he was paying on the all-in-one. And so he classified that as a no-brainer. He's like, what's the next step?
Yeah.
Well, I think it's just understanding the math. And so what I really like what you said, Adam, is the fact that you're able to go through the calculation with people, right? It's you're running the scenario, and that's really what it's about, is to actually understand what the math looks like. Because on the surface, I think most people, and myself included, if I don't understand something, it's just like, I don't want to talk. I mean, Cori's been telling me about this for quite some time, and I'm like, I don't want to hear about it. I don't know, what is this all in one? You see it advertised sometimes. It's like, so I'm glad that she was adamant and persistent to bring this to the forefront, because I do think there's going to be a lot of people to benefit from this. But it's just running through the math and understanding the numbers. It's not looking at the interest rate on the surface and going, oh, that's a higher interest rate. It's understanding the dynamics of it based on your specific situation, the exact numbers, how much money you're going to have in into that account. And no one holds a loan for 30 years. I think so often we get in this mindset where it's like, oh, I'm going to buy this property and let it be free and clear in 30 years. But nobody does that. And I think it's fiscally irresponsible, because you need to keep your money dynamic. And, that's the way you trade up, doing, with 1031 exchanges and allowing your equity to build over time. That's how you scale and compound your real estate.
Sure.
Our average clients hold for 4 to 6 years. So if you're looking, as we know, the 30-year conventional loans, they're front loaded with interest. And so, and that's, we've talked about interest only before, and it's almost like that's voodoo to talk about sometimes with people, because it's like interest only scares them. But what they don't realize is, a lot of times on 30-year fixed loans, how much interest are you actually paying over 2 to 3 years? I don't know. I digress. That's my soapbox. But I don't know. What do you think, Cori? I mean, you've had some people that have gone through this stuff. This is fairly interesting, huh?
Yeah, I mean, I like it. Like I said, Harrison and I have been working together almost a year, in a few months. And, he's had, it's really cool, because we both kind of have the same philosophy. We just really, and same what Adam said earlier, we just really want to take care of people, and whether they do something with us or not. Same as, there's people that come to Rent to Retirement and we work together or not. Same with Harrison. I'll send him people and they work together or not, but we're just going to take care of people. And I think that philosophy wise, we're just a fit. And I think if this makes sense, it's just a really interesting product, but it is understanding it. And I'm all numbers. Any investors that have spoken to me, I'm like, all right, and here's the math. And I like that you guys take the time, Harrison and Adam, to walk people through to understand the numbers, if this is going to work for them, because it's not going to work for everybody. If I could write, 20 of these, I would, but there is a limit. So you want to make sure you use it on something that's going to be the right fit in that. So.
Sure. And it's really, whether it's the person who's just now getting into real estate going, I want to build a portfolio and I haven't taken the plunge, but I'm about to. Rent to Retirement has me convinced. I like their product. I want to buy a house, versus the guy who has 12 houses already. The all-in-one's great for the person with 12 houses, because they've got tons of stream of income. A lot of the money's going out for payments, but a lot of that money's sitting there for a little bit while it's waiting to be paid. That can be utilized to offset interest on the all-in-one. The person who's just starting out, they can use all the cash flow, the peace of mind money that they have on hand to offset interest, which will reduce the principal even faster. And then they can tap into that same line of credit for down payment on the next one. So the all-in-one will actually help you parlay your second purchase as well, if you'll help us, or if you'll allow us to help you with your strategy.
I love it. Let's switch gears a little bit to talk about the HELOC on a investment property, because this is a huge challenge. It's fairly easy to get a HELOC on a primary residence, almost unheard of to find one on an investment property. So can you talk a little bit about how that product works and different loan requirements, LTVs, things like that?
I'll tell you exactly how it works. It's the all-in-one on an investment property.
Yeah, there's literally no difference.
Yeah, there's literally no difference. So a practical application would be like, well, I've got this property paid free and clear. It's worth $300,000, but now I can't get a HELOC on it. Well, you could get an all-in-one. The difference, the main difference between the all-in-one on an investment property that's paid free and clear, they want to see you pull a balance. They don't want to do all of the work on it and start it at zero. So typically they want a need for it. So if you're, hey, we own an investment property free and clear, we can do a line of credit on that because we're pulling money for a down payment, or we're paying off cars, or we're doing whatever. But they want to see an initial draw. They don't want to do it at zero balance.
Go through a numeric example with someone that owns a property free and clear using this loan.
Yeah. So you've got, $100,000, let's just say it's $100,000 for easy math. You can do a cash out 70%. So you can have a $70,000 line of credit, even if you only pulled 50 of it initially. So you can go up to 70%, and we can, the guidelines actually say max cash out 250,000, but we can get exception on those. And I've had exceptions up to 750,000 cash out with a free and clear property. If it makes sense, it makes sense. Yeah,
I love this because it's and it's more advantageous than doing just a cash out refi, whereas that money cannot come and go. And so this is, if you have free and clear property, this is and we have a lot of people that do, and that while we like the idea of free and clear, it's like, hey, there is such a thing as return on equity. And if you have equity in a house that's just sitting there not being used, like what is your return? Often zero.
Well,
right?
not to mention the person who does the 30-year fixed loan and pulls out money because they might have a need for it, they're paying interest for it immediately.
Yeah.
30-year fixed loan.
Yeah, you got to invest it. You got to invest every single dollar, right?
Yeah, yeah. So from an optionality standpoint, not even close. The all-in-one is way more efficient than just pulling the money and having it sitting in a checking account.
But again, they can only do this on one, regulation-wise, is one investment property and one primary. Is that about
2 investment properties?
Oh, okay. So yeah, if you have, so I actually think that's going to be the most applicable scenario here for our audience, are people that do have very low balances or free and clear investment properties, and I think a lot of people will be interested on their primary as well. This is cool stuff, guys. What else? I had one more question for you. I don't know. As I'm thinking here, Cori, what else do we want to cover?
Well, Zach, you said something a second ago I figured I'd touch base on. You said, people hold their property for 4 to 6 years with you guys, and how much money do they really spend in that time frame? Kind of a easy little math is around 3%. You're spending about 50% of what you borrow in interest. You get into like the mid to high fives, you're spending about 100% of what you borrow in interest. But in the first 5 years, you spend about 25% of total interest in just the first 5 years on a 30-year mortgage. So if you had a $100,000 mortgage and you had a 6% interest rate, you're spending about $100,000. And then in the first 5 years, you're going to spend $25,000 in interest. So it's, the way we look at it is like, I think that money looks way better in my pocket than being paid as interest to somebody else. Or alternatively, I think the money looks way better in my client's pocket than it does in being paid to interest to a 30-year mortgage, just because they're familiar with it and they didn't take the time to learn.
I've actually had people say this to me, Zach, that they're like, well, wait a minute, I'm going to pay less interest. I'm going to have less of a write-off. I'm like, think about what you just said just now. Higher interest is not in your best interest,
Yeah, we need to have a full long discussion with them. They need to watch one of our tax podcasts about how to pay Uncle Sam less as well. There's way more effective ways to do that through real estate. Just to be clear, this can be used on commercial. You guys, do you have multifamily options as well, or
up to 4 unit?
Yeah.
Okay, 1 to 4. Got it.
Yep.
Exactly. Yeah. But the money that you pull out could be used for anything. If you had available $100,000, you could go to Vegas and put it on black if you wanted to. It's not like you're asking for permission to pull it out. Probably from your spouse, but you can buy a business or whatever you want with this money because it is your money. You put in $50,000, or you owe $100,000 on your home and you have $1 million primary residence. Well, you'd have a line of credit of the difference from $100,000 to $800,000. So you could pull that $700,000 out and do anything you want with. You could buy 7 $100,000 properties cash, or you could go and put $700,000 down on a commercial building. You can, have access to do whatever you'd like with it.
Yeah, and you do wire transfers as far as distributing money. Write a check, debit card. For me, I do bill pay most of the time for my stuff. But wire transfer, all that, you could do mobile check deposits. It's going to be the same functionality as pretty much anybody's familiar with. It's just going to be a different banking interface.
Yeah, take 30 minutes to learn the application and you pretty much have visited every screen and read every line item on it.
I can't say even in my 7 years that I've spent 30 minutes sorting through the
automation is key. Well, this is cool stuff, gentlemen. We appreciate you sharing this. I'm sure that there's going to be a lot of interested people. So how do people find out about this and how do they connect with you?
Cori, how do you want to connect direct with us or with you, or how do you want us to do it, Cori?
I mean, everybody knows how to get in touch with us, so that's nice and easy. But absolutely, I mean, mention your business, and if somebody doesn't want to connect, we understand. But we'd love to have them come through. But I mean, go ahead and say, Zach. I don't know if it.
Yeah, we'll put a link in the show notes on how they can, if you have a calendar or how to schedule with you. So they'll just visit that link and then they'll set up a time. I think it's important for someone exploring this to fully just understand it. And Adam, as you mentioned, go through just the example with you guys, right? And and I love that because that's just education. This is stuff you got to be doing. The lending world is dynamic. It's constantly changing. There's constantly new products to be aware of, to both good and bad, and things that are more applicable to your situation, to allow you to be a more savvy investor, which is the ultimate goal. But it all starts with investigating and taking action to learn about what those options are. So, Cori, you want to sign us off here?
Awesome. I know there's going to be a button to like and subscribe if you're watching the video. I know that's what I got. If you're in the podcast, hopefully you're already subscribed to our channel. Please reach out to us for any questions at Rent to Retirement. You can, any of the investment strategists, let us help you. That's what we're here for. This is why we have awesome people like Harrison and Adam to kind of join us, just to kind of give value to you guys, which is what we really want to do. So definitely reach out, schedule some time, and let's have a chat.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.